Hello, everybody. At this time, we are talking about corporate budgeting. Corporate budgeting is the practice of determining future goals for the company and structuring finances to match. The corporate budget is set at the executive level and then disseminated throughout the company with itemized goals. A corporate budget is one that has been constructed by high level executives for the company at large, including specifications for each major and minor department. The budgeting process comes from careful analysis of future goals set by management and broken down into actionable steps. For example, the executive team creates a revenue goal for the year. Next, they break it down by quarter and divide it across each branch or unit. Local managers would then hand down an individual sales goal to a salesperson for that quarter. This type of top-down budget planning is useful for large companies, especially if they operate nationwide, because it simplifies complex budgets for low-level implementation. However, this budgeting is sometimes criticized for oversimplifications or manipulation to create. And then we move to key objectives of corporate budgeting. An effective corporate budget helps organizations achieve about the first, lower operational costs through better resource allocation. Second, enhance communication across departments to support cohesive planning. Third, maximize profitability by focusing spending where it generates the highest return. Fourth, improve readiness for market shifts, economic uncertainty, or unexpected costs. And fifth, alignment of expenses with business priorities to ensure funds are used strategically. And then six, a clear understanding of financial impact when making strategic decisions. By applying these objectives, companies maintain stability and position themselves for long-term growth. Using advanced tools makes tracking, analysis, and adjustments more accurate and efficient. And then we move to key components of a corporate budget. The first component, revenue projections. How much money do you expect to make? Second, profit expectations. What's left over after you cover all costs? Third, cost of goods sold or COGS. What does it cost to produce your product or deliver your service? And then fourth, cash flow forecasts. Will you have enough cash to keep things running? Fifth, operating expenses. Salaries, rent, utilities, marketing, software subscriptions, etc. And then six, capital expenditures. Big one-time investments like buying new equipment. And then we move to stages of budget creation. The first stage, strategic planning and goal setting. This initial stage focuses on aligning departmental objectives with the overall corporate strategy. The company's long-term goals and short-term objectives are clearly defined and specific targets are established for each department. This stage sets the foundation for the entire budget process. And then second, data collection and analysis. Data collection is crucial for accurate forecasting and budgeting. This involves gathering historical financial data, market research, industry trends, and anticipated changes in organizational costs. Detailed analysis of this data provides insight into potential challenges and opportunities. And then third, departmental budget preparation. Each department prepares its individual budget proposal, outlining anticipated revenues, expenses, and resource requirements. This requires a thorough understanding of the department's operations and future plans. The budget should align with the overall corporate strategy and departmental objectives. And then fourth, coordination and review. The individual departmental budgets are reviewed and coordinated by the finance department. This process ensures consistency across departments and alignment with the overall corporate budget. Potential conflicts or inconsistencies are identified and matched during this stage. And then we move to fifth, approval and finalization. The finalized budget is reviewed and approved by senior management. This process involves considering the budget's impact on the company's financial health and strategic goals. Once approved, the budget is documented and disseminated to relevant parties. And then we move to different types of corporate budgets. The first type, operating budget. This is the core budget that tracks daily revenues and expenses. It's your go-to for managing the business month to month. And then second, capital budget. Used for big ticket purchases like equipment, vehicles, or new office space. These aren't everyday expenses, but they affect your long-term growth. And then third, cash flow budget. Even if your profits look good on paper, you could still run into trouble if cash isn't coming in fast enough to pay bills. And then fourth, master budget. This is the big picture combo plethora of all your smaller budgets. It includes your operating budget, cash flow, and capital plans all rolled into one. And then we move to some common budgeting mistakes that you should avoid. The first, overestimating sales. The worst way to set sales targets is to look at last year's performance and tack on a reasonable growth percentage. If you want to set realistic targets that aren't consistently under or overachieve, you need to look at more than just last year's performance. You need to factor in variables like market size and dynamics, competition, expansion into new geographies, etc. And then second, not sharing the budget with relevant stakeholders. The final step in your budgetary process is to share it with all relevant stakeholders. That will give them guidelines within which they must operate and what's required of them. Your business operates with multiple teams across different business verticals. The team leads on the head of a vertical should have a copy of the budget that defines the expectations in terms of revenue and expenses for that vertical. And then third, not basing the budget on data. An accurate budget is based on hard data, not guesstimates or gut feel. The first thing you need to look at is if your budget is going to be top down or are you going for bottom up budgeting. In top down budgeting, you start by dividing sales and then divide the expenses you will incur to meet that sales target. Bottom up budgeting especially reverses the process. I think it is enough. Thanks for watching.